sector is experiencing an uplift in interest and multi-billion-pound investment. Record deals, developments and scientific breakthroughs are regularly hitting the headlines. And that's when the experience and expertise of our dedicated life sciences sector team of multidisciplinary lawyers really comes into its own. A top 50 commercial law firm, Freeths offers a full spectrum of services to the industry, including helping pharmaceutical, biotechnology, digital health, and medical device companies to de-risk business growth throughout their life cycle. You can rely on us for advice on such matters as intellectual property, securing rights and enforcing rights, for example, commercial contracts such as licensing agreements and cooperation agreements, regulatory compliance from invention to market introduction, and any legal issues regarding employment, business immigration, real estate, competition law, and disputes. We've cultivated a first-class reputation for helping clients establish, protect, and monetize their intellectual property and successfully secure their funding requirements. Our free-thinking approach is always at the heart of what we do, while our wide-ranging contacts and long-standing relationships in the sector ensure that we're well-placed to deliver added value to your business. Freeths. We know the law of life sciences.
Hi everyone, I'm Simon King, the National Director of Business Development at Freeths. I hope you're all well and thank you for joining us this afternoon for the final day of our Sector Week webinars and the first in a series of life sciences focused sessions that we will be hosting throughout the year. We are privileged today to have our panel of experts. We have Claus Andersen, Partner Head of Life Sciences at Freeths, Iona Silverman, IP Partner at the Life Sciences team at Freeths, and our guest experts, Peter Jennings, Corporate Finance Partner and Head of Healthcare Thames Valley, Grant Thornton, and Jesper Petersen, Investor, Advisor and Board Member. We will be starting the panel discussion shortly. Before we do so, I just want to confirm there will be an opportunity to submit questions during the talk. Although we've had some submitted questions beforehand, but please do so as we want this session to be as interactive as we can. You can submit your questions via the Q&A function on Zoom during the session. If unfortunately we do not get your question answered, we will follow up with you directly over the next few days. Now, I'm pleased to kick off today's session and start with a brief presentation from each of our panel members on our topic, keeping the lights on. How do you raise money from UK and international investors to sustain your next phase of growth? Peter, can I come to you first?
Thank you very much, Simon. Very opportune. As that happened, the lights went off in the room. So my lights are back on. So my topic is to set out the various types of investment that are available. And I'm going to do that by talking through the life cycle of a business and particularly in life sciences and a startup. So at the first stage with a new business, a new enterprise, there's the seed investment round to start with, and this typically comes from family and friends. It can come from angel investors. It can come from academic institutions, and this is the money that allows the business, the idea, to begin and to start. Once that money has taken that opportunity or that idea to a certain stage, then that's the second stage of funding, typically called Series A. Series B and Series C then follow. Series A tends to be the first stage when institutional investors are introduced to the funding cycle. The benefits of introducing an institutional investor are that they bring with them business expertise, they bring with them additional resources, and they bring with them connections. As is the case with any equity investment, the downside is dilution, loss of control. And this is the delicate balance that needs to be undertaken. And at what point do you give up equity or sell equity, and at what value? And this brings us on to the second part of the opportunity, which is the debt side of things. Typically, businesses need to have been much more established and proven, often at least having turnover and a line of sight to profitability before even venture debt can be introduced. And the benefits of venture debt are that the purpose of venture debt is it extends a runway, it provides a runway to another valuation event, or it also avoids a down round. So if it hasn't performed in line with expectations, you don't need to have another equity round of investment that could cause a dilution and an undervaluation. Some of the terminology you just wanted to explore in venture capital, which tends to be the term used for Series A funding, is essentially private equity funding for growth investments and to provide growth capital. The venture capital market in the UK is promoted by tax efficient investment schemes, EIS, SEIS, VCT investments, and there are a lot of funds around that have raised funding based on these approved tax efficient mechanisms of retail investors supporting growth companies. That is a very kind of UK focused way of doing the venture capital side of investing. There are different dynamics, and we will hear from Jesper later on around some of the Nordic style of venture capital investing, but also US appetites for venture capital are slightly different and probably slightly more aggressive in terms of risk appetite. And that is something that we'll hopefully explore later on in the panel in terms of the different outlooks from different territories in terms of their venture capital appetite. So that was the outline of the different types of investment and different stages during a life cycle, and we will get into it later on in terms of where different sources of capital, different sources of funding can be used and where they're appropriate. And we'll also get into what makes an investment opportunity appealing to those investors and at what stage.
Klaus, can I turn to you now?
Yes, hello everybody. So we have just been, Peter has just explored the various options for investment. What I'm going to speak about is how a business prepares itself for investment. And fundamentally, there are two sections or two parts of the preparation. The first is the commercial part, that obviously a product or service is developed, etc. A business plan is prepared. The second part is preparing the company from a legal point. Put simply, an investor wants to invest in a company that is commercially sound and where the risks from a legal point of view is minimized as much as possible. Therefore, you don't want as a business to prepare a too difficult business case for an investor. And there are a couple of areas that could be useful to look at for a business. An investor, when it looks at a company, would focus on who owns the company. What is the share structure? Are there one shareholder? Is there more than one shareholder? Do they have a shareholders agreement? Do they have an agreement about what to do if an investor wants to invest in the company? Have they made up their mind what kind of equity they perhaps want to give away and on which conditions? So that's one aspect. Another aspect is if the business, like many life science companies will be, dependent on compliance, authorizations from public authorities, that authority, that license is valid, that it covers the whole of the business. So it's useful for companies to make sure before you go to market to invest that you got your licenses and your authorizations in order. Also, for many existing companies and businesses, you need to look at your contracts with your suppliers and your business partners. You want to make sure that you actually do have a proper written contract with your business partners. Are there any customer contracts, business contracts that are coming up for renewal? Then it would be sensible to make sure that is sorted out, because an investor will look at the contracts. They will look at the terms of the contracts, in the process. Likewise, many life science companies will be hugely dependent on their employees. It's very important that the employees have got a written employment contract, that employment contract deals with issues like confidential information, restricted covenants. What happens if, let's say, a chief scientific officer leaves the company? Where is the company positioned then? So those are very, very important questions. And another aspect which is also quite important to look at is the property. The company will usually have some sort of release agreement with a landlord. It's obviously important that that the company can stay in that property, and that there is a room to scale up so the investment can be used most sensibly. Another aspect is the IP, but my colleague Iona Silverman will discuss that further.
Thanks, Claus. Hi, everyone. I hope that I'm not too crackly because I feel like the internet's not too great. So if I am, please someone wave at me. I really think that I want to pick up on what Claus said about preparing your business. And basically, it's about getting your house in order when you're looking for investment. I want to pick up on two really basic points from an IP perspective. I mean, intellectual property is so crucial to all life science companies. And you're always generating it in various different forms, but it actually is quite frequent that our clients haven't actually thought about exactly what IP it is that they're using. They are generating it and they're using it and they're making money from it, but they haven't necessarily considered what it actually is. And then secondly, they haven't always thought about, which sounds such a fundamental point, and it is, but it's very easy to overlook it. And I think that when I'm doing due diligence on companies because someone is looking to invest or someone is looking to take that company over, that's what I'll be looking at, is you actually own your IP. So I wanted to touch on those two things. So first, understanding what IP you own. There's the obvious patents. People always think about patents when they think about life sciences, and that's absolutely right. But a lot of companies might not own patents, and that is absolutely fine. You might be at a stage in your business where you have developed an idea, but you've kept it confidential and you're not sure you're ready to share it with the world, and that is absolutely fine. So if you're at that stage and you haven't shared it, but as long as you've kept it confidential, that is fine. I'm sorry if I'm cutting out a bit. Please just shout if I need to go back over anything. So patents, you may have applied for, but if you haven't, it's okay, because you can protect them using, you can protect your invention using confidential information. If you're at the stage of filing for patents, that's fantastic, but make sure you consider patents on a global scale. And I say that even if you are just a UK or a business that is concentrated in a smaller geographical area, you will want to think about patent protection on a global scale, because you don't want to lose novelty if you apply in one country and then can't apply in others. So just think about that on a global scale. I would also think about trademarks. People don't always think about trademarks when they think about life sciences because it's so invention-based. However, trademarks are key both to protect your company branding, but also each product that you sell will have its individual brand. You know, we go into the pharmacy and we know what we're looking for. Are we looking for Boots' own brand, or are we looking for a particular branded product? And that's true not only of pharmaceutical products, but all products generated in the life sciences industry will be protected by brands. So don't forget to register those trademarks in the countries they're going to sell those products. Another thing to think about is software. Traditionally, it was only tech companies that thought about software because that's what they did. But now every single company in every single industry will be using tech. That is undeniable. And a lot of companies are developing their own tech for particular purposes. And this is true of a lot of companies in the life sciences industry. And when you develop software, you generate copyright in that software. And that copyright will be owned by whoever has developed that software. So if you are using a third-party software developer, you need to make sure that you have an agreement with them setting out who owns the IP in the software. And if your employees are developing software, as Claus said, you will want to make sure that your employment agreement covers intellectual property and who owns that. So being really clear on that is important, because IP is not copyright is not a registered right. So you can't see on a register who owns it. So you need to have a really clear paper trail to show who owns it. Worth also touching on designs, because I worked with a lot of companies who have designs in molds, for instance, that they use to make their products, and perhaps those factories are in different countries. So worth thinking about whether you've got IP in those molds that you want to protect. And also about know-how. I've talked a little bit about confidential information, but know-how is similar. It is the knowledge and the information that is in, say, how you make something, a process of doing something, perhaps a recipe, a formula, and there will be an unregistered right, which is know-how in that. And that is also so crucial to the life sciences industries, because of the way you're making things is very innovative. But again, you need to make sure that that is kept confidential, and that you have the documents to show that it's kept confidential, so that when you're getting an investor in who's looking at everything, they can feel comfortable that actually, yes, you know this, but crucially, you haven't shared it with anyone, possibly inadvertently, and they will want to be really clear on that. So I think it's worth running through what IP you think you use, and then running through whether you actually own it and whether you've got the paper trail to show it. And it's not a huge job, but I think in doing a relatively high level audit, you can identify areas where there may be a gap that you need to plug, and it's so much easier to plug that gap nice and early than it is to wait until you've got the investors in and you're trying to do everything to show them that you do own your IP. So at a high level, I mean, I could talk about IP all day, but at a high level, I'm going to stop there and hand over to Jesper.
Thank you very much. Well, it's sort of tough to be the last one here speaking, because all the good stuff has been said already. But I will start off with, as an investor, advisor, and a board member, I utilize all of the above. So Iona, Peter, Claus, and if I can get away with it, also I'll abuse Simon's knowledge. I have a little bit of a different background from most investors, as in I come from the institutional, corporate, and investment banking background. And I've done everything from the very, very large companies to the very, very small companies. And today I sit on a dozen or so boards and invest in even more companies. The knowledge that the esteemed speakers before me have shared with you is essential. And I cannot underestimate the value of having good advisors on board. And believe you me, I've met some good ones, and I've also met some disastrous ones. And this disastrous ones was in the beginning, and then you learn. So just a few observations seen from an investor's point of view. And I am slightly blessed in a way, because I got a half decent background, so I know a little bit about it. And I sit on 3 different VC boards as well. So I see a fair few companies. So just a few observations. Don't make the mistake of using bad advisors. It will bite you in the bum and will cost you a fortune. And it will make the difference between failure and success. And you want to be successful when you put your money in. When you talk and when you evaluate a company, do look at the composition of the team. Do they complement each other? Things like that. Look at the runway of capital. Peter, he mentioned how to raise capital and in what in different rounds, all the way from friends and families to seeders and VCs. Be aware, who are the other investors? What are you complementing? Are the other guys smart guys, or is it sleeping money? What is it? So not only look at the company composition of the team, but also look at the investor composition. Who are you in bed with? It can make a difference. One of the things that I think a lot of companies they unfortunately miss in their sort of capital raise and running of the company is the utilization of equity, warrants, options, growth shares, EMI opportunities in the market. There's a lot of, I wouldn't call it free money, but there's a lot of opportunities in the market to utilize it. And why would you give away equity to your staff? You've got long-term commitments. You've got people who will stay with you for a long time, and they actually have an incentive to stay with you for a long time. And I think, unfortunately, it's a little bit underutilized. It's especially underutilized in the Nordics. People, they don't use it as much. One of the reasons being that the incentives models are more liberal or more generous in the UK, I would say. The share schemes and the options in UK is far more beneficial. And from an investor, Peter, he touched upon it before with SEIS and EIS. It's almost criminal not to use it if you can. So please do use it. And for you as an investor, it also makes a difference whether you're investing in a UK company that can get SEIS or EIS, or you do it in a Nordic company. And being at least half Danish, I know that the Danes, they would like, or the Nordics, they would like to compete with the UK, but the tax efficiencies are not as generous in the Nordics as they are in the UK. They can make a big difference for you as an investor. Then I want to speak a little bit about we talked about the composition of the team in the company and also the composition of the investors. Then also think about when you invest, what is the loyalty around the product and the clients and the investors? Is the company looking at an ecosystem of loyalty around it? This will go a long way of creating ambassadors, smart investors, and ecosystems where you can utilize each other and leverage each other. What else would be good? There's a thing that I noticed from Iona, and Iona, she's probably forgotten more about patents and IP than I will ever learn. But I have had a little bit of touch with it, especially for a company in the US, where we learned having a patent is one thing, defending it is a different thing, and it can be very, very expensive. So as an investor, don't think that just because you're investing in a company who's got a patent, that's a safe and secure way. It could be challenged, and the way to defend it is very cumbersome and can be very, very expensive. And the last little thing that I'll share on IP and patents is, when you're there anyway, try to see if you can get a divisional application. So you can constantly, you will get your patent approved, and then you can constantly tweak or add little bits and pieces to it. And that makes a big difference for you as an investor, especially when the company wants to be sold. So you have invented something that's super smart. The company is interested in buying it from you, but they would like to add 1 or 2 features to it that you haven't thought about. That's when your divisional application is really, really useful. And it costs you very little to have it anyway. So take that one on board as well. And I think, as an investor, try to focus. Try to focus. And then I'll hand over to Simon King. And hopefully we've still got a few listeners if I haven't bought the socks off them yet.
I'm not going to talk about investment, but I'm going to pass the next question on to Claus as to when should you as a company looking for investors contact advisors? What's that timeline look like?
Well, I would say as soon as you as a company decide that you want more money, that you want an investment, there's nothing more frustrating for advisors than to come in too late. So, for instance, to come in when you have to pick up a share structure that is not right. Where you have to change a perhaps half-done shareholders agreement, to come in the process where the potential investor has already been negotiating with the business, and where you can't really change the facts on the ground. You can do something, but it will always be advisable to contact people as soon as possible. In the end, you will discover as a business that it's also much cheaper to prepare the ground.
If I could just add to that as well, Klaus, I think that you want to make sure you get the right money at the right time, and you want to get the right amount of money. There's a lot of examples of companies that have raised just about enough money to keep going, and are then constantly in a cycle of fundraise after fundraise, and don't get enough time to actually focus on what the business should be doing. And just touching on the points we've seen before around making sure that introducing advisors earlier so that they can help present the opportunity in the right way, and investors know what they like to, they need to see certain things, and those things are clear milestones around what the funding is going to be used for, what those, you know, those milestone events. Is it around commercialization? Is it around regulatory approval? Is it around turnover being received? Is it around profitability? But having those clear milestones set up are so important for the investors, and having achievability of those milestones, realistic achievability, is important, so they know what they are buying into, and also they're not getting frustrated or disappointed if those milestones are unrealistic and not achieved. So I think it's better to set it out clearly from the outset around what is realistic and what is the aim, and so that you can get the right backers at the right time to support that goal.
Great, thank you, Peter. I've got a question for you, Iona, on this one regarding know-how. Can you monetize know-how even though it isn't a registered IP right? Well, I think now you may have frozen. I'll move on to the next question, which I'll direct towards you, Jesper.
Okay.
What's the most important learnings you'd like to share as an investor?
Oh, how long have we got? For me, every day is a school day, and I'm very humble when I look at stuff. There are so many people out there that knows so much. I would say, as an investor, do your homework, and when you think you've done it, do it again, and then look at the competition. Drop your emotions. It sounds horrible, but drop the emotions, because you get carried away when you are presented to these different things. Let me share a very quick example. I sat at a VC fund, 12 different companies were presented. I was ready to write checks to 10 of them. And then the guy next to me, who's been there 20 times, he looks at me and said, "You lost the plot. What's the chance of 10 out of 12 companies being the right companies here this evening?" I'm just like, yeah, of course. So drop the emotions, stick to what you know, focus on the markets where you really know something. That will be focus.
So we've touched on venture capital. Peter, I just want to come to you. What do you think are the pros and cons of taking on venture capital investment?
Well, I think that the benefits it can bring are those that business expertise. Sorry, I'm in a room that's got a timer on the light. Business expertise they can bring, and that know-how. So, you know, they're experts in their field around getting to the next level, getting a business, commercializing a business, or getting it through regulatory approval, or getting it to a stage where the next round of investment can come and the business can be more successful. So I think that the mindset is to have a smaller slice of a bigger pie, you know, to have a partner on board which will support. And sometimes building your own business and leading it forward and taking your own, it can be quite a lonely place. And having an investor on board that's been through it time and time again can help guide and be that guiding light as to what some of the challenges that you'll inevitably face as you go on that journey, and what's the right time to employ those new people and those senior hires and get the right team around them. The other benefits are the connections that they bring and the additional resources that they can bring to bear, so that, you know, that as they have, those investors inevitably will have done it before to some extent. They will have experience and contacts that they can bring in that will be helpful at the right point in time that otherwise may not be available. So I think those would probably be the three critical areas, I'd say, as to the benefits that they can bring.
I'll just come back to, sorry, we lost you for a moment there. I think you're back with us now.
Hopefully I'm back. And
yeah.
You were asking me about the licensing of know-how, whether it was possible to license it even though it's unregistered.
Correct.
So yes, absolutely, it's possible to license know-how. I think typically you see a patent license and you've licensed it out to generate revenue, but alongside that, your licensee may well want a license of know-how in order to know how to use that patent and to maximize the way of using it. So absolutely, you'll often see know-how licensed alongside a patent, and you will also see it licensed by itself. So don't think that if you haven't got a patent, you're precluded from monetizing your know-how, because you're not. You can use that know-how to generate revenue if there are third parties that are interested in using it. You just need to be really careful that you're keeping it secret, and that you're maintaining that confidentiality, and that your employees have got restrictions on them, so that if they leave your company, obviously you can't unknow what you know, so you can't stop your employees knowing how to use this process, but you can impose appropriate contractual restrictions on them. So making sure you've got those in place so that your licensee can feel comfortable that they are protected.
That's great. You are cutting out a bit, but I know you and I have discussed this. We will set up a briefing note just in case that everybody didn't quite follow you. Klaus, active investors.
Yeah.
Or passive investors. What are the pros and cons, and how would you decide?
Well, I mean, typically active investors would be investors that would like to become involved in the running of the business they're investing in. And I would say that the pros are that that obviously hopefully you will get people who've got experience, got contacts in the sector. That can be especially very useful for companies in the early phase, where perhaps they are developing a product or a service. They have developed a product or service, but they haven't traded for that long. So you need to get into new markets. You need to get involved with people who've tried it before. The downside is also that when you let people in and when they start to get involved, they may not necessarily agree with what you're doing. They may not necessarily have aligned themselves with your vision. You can, to some extent, regulate that in the shareholders agreement or in the investment agreement, where you set out how you would run the company with the investment. But I think from a sort of psychological point of view, it's important that companies make up their mind what they want. The sort of other extreme is a passive investor, someone who just, in inverted commas, parks some money in a company, gets quarterly, annual updates about how the investment and how the company is doing. Obviously, they may not necessarily be there active. They may not necessarily have contacts or are prepared to share contacts that can be used for the business. So typically, that sort of companies or that sort of investors would be more beneficial for, let's say, more mature companies. I think the important thing is that a business looking for investment, as part of the preparation, decide what kind of investor they're looking for. Are they looking for an active investor, or are they looking for someone who just needs or who's just parking the investment? And then I think it's important that the documentation is tailored to that specific situation. So if you've got an active investor in, you want to make sure that the people who founded the company still got a say in the company. And I think for both types, it's also important that you discuss what a potential exit perhaps may look like. And that can also be, to some extent, decided in the documentation, in shareholders agreements, articles. I think that's the closest. I don't think that one investor is better than the other. I think for some companies, active investors are better because they're younger, they need the contacts. For other companies, it's a passive investor because they need the money to perhaps expand into new territories.
That's interesting. So either way, what's important is getting that fit right.
Yeah.
Peter, in your opening statements, you did mention different attitudes to venture capital. What are the different attitudes of the US and UK to venture capital?
I think that the venture capital market in the US is probably more advanced and with a higher risk appetite. I think that there's an attitude in the US that if you haven't failed, you've never been a proper entrepreneur. So I think that there's a healthy regard or a healthy appetite for failure in the US, whereas it's a bit more conservative in terms of the investment attitudes in the UK and elsewhere. So I think that there's the venture capital market in the US probably has a more of a portfolio approach, whereby there will be some that don't work and there will be some that really work. And it's a bigger pool of investors. The market in the UK, is very heavily tax incentivized, and so it's slightly more conservative, looking for probably slightly or happy with slightly lower or less spectacular returns, but wanting the returns to be more stable.
Excellent, thank you. So Jesper, what do you focus on a startup or a fledgling company?
Oh, many different things. First, I want to focus my mind on what sort of type is it? Does it fit into my portfolio? But if I should start with just 2 or 3 things, I will look at the team, the people, and the composition of people. How do is the founder alone? Are there 2 or 3 founders? Preferably not any more than 2 or 3. One alone founder can be a bit tough and lonely. So the composition of the team, how do they interact? How realistic are they? Then I look at the scalability of the product. Would I buy it, or do I know somebody who would buy it? And is there a market? Is that a scalable growth market for it? Or is it something we can only sell in Cornwall? Or is this a truly global market? So it's again about doing a bit of your homework. And what will be the last thing? People, of course, everybody or many people, they will start with the product. Is it interesting? I would say if the 2 other things are right, I wouldn't say the product doesn't matter, but as long as you're in your focus area. But if you have the best product and useless people, they're sure to screw it up. So I'd rather have a little less good product than I could add some stuff to, than have the right people to do it in a growth market. So composition of team and founders, scalability, and then the product, and in that order.
Excellent. Talking about product, I think intellectual property more and more is playing an integral role in life sciences. So Iona, how do I go about auditing my IP to check what I actually own?
It's a good question, actually, and it's something that I think all companies should do on a relatively regular basis, just to sense check what it is that they own. And I talked a bit about that, but I think the steps that you could practically take yourself to check would be to check your registered rights. That's relatively straightforward. There are publicly accessible IP registers online for the UK at least, and for many countries. And you can go online and you can check, do I own trademarks? Do I own patents? What names are they registered in? Because particularly if you've acquired them from someone else, you want to make sure that the register's up to date, and that it's reflecting everything that you think it should reflect. So that's relatively straightforward. And if you don't know how to do it, it's relatively inexpensive to get somebody to do a proper check for you. When it comes to looking at unregistered rights, it's a little bit more nebulous. I would say you want to think about what unregistered rights you use. Is it copyright in software? Is it know-how? Is it confidential information? And then check the paper trail. Check that from whether that product or that idea was conceived, that there is a paper trail to show you that you do own those rights. And I think if you can get those two things lined up, you've got yourself in a pretty good shape to show an investor that you do own the IP that you're using.
Excellent. Klaus.
Yeah.
We've talked about good fit. I think there's a stream here of others having a good fit with the investors and the company itself. But what should I do if, as a business owner of a company looking for investment, discover something negative about my company?
Yeah, what should you do? It sometimes happens when you look for investment and when you start preparing that perhaps something has not been recorded right. Maybe you need to apply for authorization. Maybe your IP is not recorded correctly or registered correctly. Likewise, share structure. I think the common theme is that most of these are something that can be remedied, and obviously investors will be different, but I think most investors would have some sort of understanding that when you start a business, there may be something that's not sort of from a legal point of view been done quite correctly, but usually you can remedy it. But the worst would be if you try to conceal it, because an investor will discover it and it will become an issue. So the best thing is to be honest, be upfront. The issue, I think, is that if an investor gets upset because of that, then they are unlikely to be suitable for your business anyway. Likewise, especially for companies that have been trading a bit, they may get from time to time emails, communication from customers who are not quite happy with the product or service they've received. But usually it will never materialize to anything. But again, the sensible thing would be to be upfront, because if you try to conceal it and the investor discovers it, the only thing you get, worst case, you will get a lawsuit. Perhaps the investment will be aborted. And in any case, what you would experience is that the investor lose faith in you and perhaps want to exit and don't want to work with you again. And then there's the reputational damage. Something like this could potentially, in some circles, get around. So the recommendation is clearly to be upfront and honest. Don't take it as a defeat. Many investors, and it will be interesting to hear what Jesper and Peter thinks about this, but many investors would be sympathetic in that situation.
Seems so, Mike.
Sorry, Jesper, please.
Oh, sorry. I think you're spot on, Klaus. Be upfront. You don't want to have a management or a founder that is dishonest to his investors. And we all know, and we all grown up, we know there are risks, especially in smaller companies or younger companies. So there is an understanding that something could mishap. So be upfront with it. Most of it can be remedied. There are tools that can help you as a startup company, even as an established company, to keep track of your equity, of your warrants, and of your options. That's very often where it goes wrong, because people, they do it in an Excel sheet, and then you have 4 different rounds, and you forgot to calculate correctly, and all of a sudden you come to IPO, and you thought you owned 12%. however, is now 4% because it was not diluted correctly in the previous 7 round. That's a problem, and that's something that is easily fixed for pennies. So that we're silly not to do that. Yeah, most investors, they will be understanding, and they will actually help.
Peter, anything to add?
I was just going to reiterate a lot of those comments, but probably just add that the investor-investee relationship is based on trust, and if you undermine that trust, or if something goes wrong, then it's a difficult relationship from then on in. So I think that is paramount, that trust and honesty part.
Yeah, excellent. Now, one thing that's been interesting to me, we've mentioned scalability, and a question I'd like to ask, that if we've started off with the investment, what happens if it comes to a point of scalability that I need another investor or reinvestor? What type of route should I be taking then?
Should I take that one first, Jesper?
Yeah.
So this is kind of goes with the rounds of funding. So if it's been a successful investment and it's in line with plan, and needs another round of funding to expand into a new area or to further commercial. Often, if it's been successful, those who have invested earlier will want to continue to follow their money and continue to invest. And equally, if it's been very, very successful, your options are then that you can either IPO the business and create some liquidity by listing, or even you might become attractive to for a sale or some other type of corporate exit or action. So that would be the sort of the typical funding rounds that you really see.
Thank you.
Yeah, I'm totally in agreement with that, and I will say horses for courses. Each stage of the company have different types of investors that are suitable for it. And I think if you're smart and if you started a company and it's successful, you are smart. Then utilize it. Utilize the investors and say, okay, now I'm going into Singapore. Can I find an investor in Singapore that can actually help me locally get into the right connections? And I see more and more with angel investors and also more professional investors that some of them actually enjoy being in the very early stages, and they like to follow the first 1, 2, 3, 4 years. And they're quite happy to get out after made whatever 5, 10x, and then sell, if not all of it, then a part of their investment to another investor, saying, you guys run a different sort of portfolio, so why don't you take it from here? And then they reinvest the money in a new startup company. So it's, yeah, horses for courses. Different stages have different preferential investors.
And a lot of those investors in the early stage or throughout will have a time period for their investment. So there is a natural cycle for where it might not be right for that early investor to continue to invest. The equity check that will be required to continue to fund the business might be at a level which means that early investor cannot continue to participate or continue to fund. And it's a natural sort of evolutional cycle of the investor base that they might exit with a new, more appropriate investor comes in. So it's part of the cycle.
Sure. Yes, I'm going to stick with you on this one as being an investor yourself. So which one of your companies or investments have performed the best and why?
Well, not many of them, to be honest. I made some spectacular mistakes. And why did I do that? Because I invested with my heart and emotions instead of being cynical and heartless. The ones that perform best or are still performing best are the ones where I understand the business. So I actually know something about it. I can quiz the owners. So I can see the context. So yeah, where you really understand it. The ones where I did my homework. And when I thought I'd done it, I did it again, and then I did it for competition, and then I make my decision. And you should never rush into any of these things. There will be another one if you miss the boat on this one, so don't worry. And the ones, at least for me personally, and I appreciate that I might be ever so slightly different investor, the ones that have been by far the best are the ones where I've been allowed or able or forced my way in to add value to the company, as on the advisory board, on the main board, or if not myself, then I could promote somebody else to come in. I can see if somebody needs whatever skills and I don't have them, but I know somebody who has, then let's get them in. So where I could be able to contribute to the companies.
Excellent. So, sorry, Jesper, we've probably got time for one more question. Maybe a general one as regards, just something from all of you as regards, what are the key attributes to matching a successful company to an investor? So let's start with you, Claus.
Well, I think the usually investments that go very well are where the people behind, so the investor and the founders, well, they understand each other and get along. Because most companies, they still rely on people working together. You can obviously have companies that are so big where it perhaps doesn't really matter so much, but especially in the life science sector, I think one of the key aspects is that companies looking for investment, that they get investors that have some knowledge of the sector, because it's slightly different. Obviously, life science, it includes, you know, everything from pharmaceuticals to over medtech, health tech, medical device, and other service providers to the industry. But one feature of many products in this particular sector is that it takes a lot of time. So what you need to do as a company looking for investment, and especially if your product is a product that takes a lot of time to develop and you perhaps need to go to clinical trials, etc., then it is important that the investors you speak to, that you get a sense that they understand this and they accept it. And they also understand and accept that sometimes in clinical trials and in the development in general, things may not entirely go to plan. So obviously what we saw during the height of the COVID pandemic was that a vaccine was developed quite quickly. That is actually the exception. Many times you would do agreements, cooperation agreements, where the first product will be launched 4 to 5 years after the early discovery process, or sometimes even longer. So I think for this particular sector, it's really important that businesses engage with investors who understand and appreciate that particular aspect, and understand and appreciate the regulatory aspect and the IP dependency. That was a very, very long answer to your question, but I think that's crucial in this sector.
Anything else, Jesper?
It was also a good answer, Claus, and I agree with what you say, which is not always the case, but in this one it was. So engage with investors, and further to that, I would say expectation management. As a company and as an investor, be open. What is it that you expect? If you are, to Claus's point, if you are a quick investor and you're talking to a medical device or a medical product developer or invention, it will take years. It's no good if you want your money out 10x in 2 years, if it takes 5 years to launch the product. So expectation management, and that goes 2 ways. And then I would say a little heads up to the companies. Remember to inform. You are in that company all the time. Your investors are not. So inform your investors. Tell them, at least on a quarterly basis, if it's a flimsy email with 5 lines in, it's going really well, or we screwed this one up, or this is on its way. They like to be involved. Investor sees this as their baby as well. So inform them, include them, and then utilize the investors as well. Ask for names, contacts, experts. It's good. And now I think the real gold nuggets are going to come from Peter.
I think most of them have been said. I was going to actually build on what you both said, and particularly what Claus said. In life sciences, it's a real technical assessment as much as a financial assessment of an investment opportunity. You know that, and as coming from a financial background, when we're assessing these opportunities, they all look amazing, and there's some really great ideas that addressing a much needed requirement. But unless there's a route to commercialization and an achievable route to commercialization, it won't be a successful investment. So I think that finding an investor that is experienced in the space, that is able to help make that technical assessment on the right path and trajectory, and support with that journey, I think that's the partnership you're looking for.
Iona, final say from you.
It's not an IP question, so I don't have
just protect
the answer, but I'd pick up on what Claus said, which is that it's all about relationships, and I think that's true of everything, right? Every business, everything we do really comes down to relationships, and I don't think this is any different. That you have a relationship with your investor, and if you get on well with that person and you understand each other, and as Jesper said, you communicate with each other and you manage expectations, then that relationship's going to flourish. So I think it is about ultimately about people.
Absolutely. Well, may I take the opportunity to you all for joining us today. Special thanks to Claus, Iona, Peter and Jesper for their thoughts and insight. And a very special thank you from me to Molly Dyson in my team for all the hard work this week in putting the Sector Week together. We will be following up with you over the next few days with answers to any unanswered questions, together with a copy of today's session. Thank you once again for joining us, and please stay well and keep safe.
Thank you.